Hello, this is Derek Izuel, Chief Investment Officer for Shelton Capital Management with the Shelton CIO Minute. Emerging markets are off to a strong start in 2026, with the MSCI Emerging Market Index returning over 9% in January, relative to 2% for developed markets. And this follows 2025, where emerging markets returned over 34%, twice that of developed markets. We've had four drivers behind this strong performance. First of all, emerging markets started from record low valuations at the beginning of 2025. Combine that with better economic growth around the world, more accommodative financial conditions, and most notably, starting to see considerable dollar weakness. Now, can these conditions persist? Can this performance persist? Well, initial signs show that perhaps it can. Earnings have been improving in emerging markets, driven mostly by upgraded guidance by the semiconductor companies. And these relative valuations still remain, with emerging markets in the mid-teens, while developed markets are deep into the 20s. However, this is not your father's emerging markets. There's a slightly different bent to EM now, and that comes in the form of investment in artificial intelligence. Much like in the US, emerging market equities are concentrated in 5 stocks that constitute over 25% of emerging market equity indices. Those would be Taiwan Semi, Samsung, SK Hynix, and Alibaba and Tencent from China. For investors considering investing in emerging markets, we believe balancing exposure to the AI supply chain versus more cyclical areas such as Latin America and Asia-Pacific equities beyond technology can provide better diversification. For more information, don't hesitate to contact your local Shelton Capital representative. This has been a Shelton Capital CIO Minute.